Have you ever heard the term high RMP and wondered what it means? It's not some complicated Wall Street jargon or get-rich-quick scheme. In fact, it's quite the opposite. RMP stands for High Return Money Principles, a philosophy for building wealth that's less about chasing fast cash and more about making smart, sustainable financial decisions. It's about playing the long game, not the lottery. So what are these principles? Let's break them down. At its core, high RMP is built on three powerful pillars: compounding, long-term thinking, and asymmetric risk-reward. These might sound a bit technical, but the ideas behind them are incredibly intuitive and powerful once you grasp them. This isn't about being a financial genius. It's about being patient, disciplined, and strategic. It's about intelligent money, not just quick money. Let's start with the first pillar, compounding. Albert Einstein famously called compound interest the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. It's a simple concept. Your money makes money, and then the money your money made starts making its own money. It's like a snowball rolling down a hill. It starts small, but with time and consistency, it grows into a massive force. Think of it this way. If you invest $1,000 and get a 10% return, you have $1,100. Next year, you're not earning 10% on your original $1,000. You're earning it on the new total of $1,100. This creates an exponential growth curve. The early years might feel slow. You might not see dramatic changes in your account balance, and it can be tempting to get impatient. But this is where discipline comes in. High RMP is about understanding that the real magic of compounding happens over decades, not days. It's the ultimate reward for patience. To truly harness compounding, you need to start as early as possible. Time is your single greatest asset. Someone who starts investing a small amount in their 20s can easily end up with more wealth than someone who invests a much larger amount in their 40s, simply because they gave their money more time to compound. So the best time to start was yesterday. The second best time is right now. This brings us directly to the second pillar of high RMP, long-term thinking. In today's world, we're conditioned for instant gratification. We want 2-day shipping, on-demand streaming, and immediate results. This mindset is poison for wealth building. The stock market fluctuates daily. News headlines scream about crashes and rallies. It's easy to get caught up in the noise and make emotional decisions like panic selling during a dip or FOMO buying into a hot stock at its peak. Higher MP teaches us to zoom out. Instead of focusing on the daily or weekly charts, look at the decade-long trends. Historically, despite all the crashes and recessions, the market has consistently trended upwards over the long term. A long-term thinker understands that volatility is just the price of admission for higher returns. They don't try to time the market because they know it's a fool's errand. Instead, they focus on time asterisk and asterisk the market. This means developing a plan and sticking to it. It means consistently investing, whether the market is up or down, a strategy often called dollar cost averaging. By investing a fixed amount regularly, you automatically buy more shares when prices are low and fewer when they are high. This smooths out your purchase price over time and removes emotion from the equation. Long-term thinking is about having the conviction to stay the course, trusting the process, and ignoring the short-term noise that derails so many people from their financial goals. Now for the third, and perhaps most strategic pillar, asymmetric risk-reward. This sounds complex, but the idea is simple. You want to look for opportunities where the potential upside or reward is significantly greater than the potential downside or risk. Imagine a bet where if you're right, you win $100, but if you're wrong, you only lose $1. That's an asymmetric opportunity. You can be wrong many times and still come out way ahead with just one win. In investing, this doesn't mean gambling on penny stocks. It means making calculated decisions. For example, investing in a well-diversified portfolio of stocks has historically provided asymmetric returns. The most you can lose is your initial investment. Your downside is capped at 100%. But the upside is theoretically unlimited. A company could grow 10, 100, or even 1,000 times its original value over several decades. Your potential reward far outweighs your potential loss. Another way to apply this principle is through what's known as a barbell strategy. You put the vast majority, say 90%, of your capital in extremely safe, low-risk investments like government bonds or high-yield savings accounts. This part of your portfolio is protected from major losses. Then you take the remaining 10% and invest it in high-risk, high-reward ventures. These could be things like startups, new technologies, or other speculative assets. With this strategy, your maximum loss is limited to that small 10% portion. But if just one of those high-risk bets pays off spectacularly, it can have a massive positive impact on your entire portfolio, far outweighing any small losses. This is the essence of asymmetric risk-reward. Protect your downside while giving yourself exposure to explosive upside potential. It is about building a financial life that is robust and antifragile, one that not only withstands shocks but can actually benefit from them. So, when we put it all together, what does a high RMP approach look like in practice? It is not about day trading or trying to find the next meme stock that will supposedly go to the moon. It's about a disciplined, intelligent approach to your finances. It starts with living below your means so you have a surplus to invest. You can't build wealth if you're spending everything you earn. From there, you automate your investments. Set up regular transfers into a diversified low-cost index fund or ETF. This puts compounding and long-term thinking on autopilot. You're consistently buying into the market without having to think about it. Then you let it be. You resist the urge to constantly check your portfolio. You don't panic when the news reports a market correction. You have a long-term plan and you trust it. You educate yourself not to become a market timer, but to understand the principles you're following. This knowledge gives you the confidence to stay the course when others are panicking. And finally, as your wealth grows, you might start exploring those small, calculated asymmetric bets with a tiny portion of your portfolio, always ensuring your core wealth is protected. High RMP is a journey, not a destination. It's a mindset shift from seeking immediate gains to cultivating lasting wealth. It's about recognizing that the most powerful forces in finance are time, patience, and a sound strategy. It's not about being the quickest, it's about being the smartest. It's about building a financial future that is secure, prosperous, and built on a foundation of proven principles. Thank you so much for watching. I hope this breakdown of high-return money principles was helpful for you. If you found value in this video, please give it a thumbs up and consider subscribing for more content on smart and sustainable wealth building. Let me know in the comments what you think about this approach. See you in the next one.